just when you think Meta's done going down, 73, man.
Yeah, I mean, I think that's pretty much in line with what we said after the earnings print, right? Like based on our math, that this thing could be a stock that's in the 70s. Google, my math is that like if you assume $4.70 in earnings, 15 times gets us a $70 stock.
Holy shit!
I mean, and I still think
it's like you guys replying the way that you and Ami just did, like quickly. I mean, man, that's alarming. I mean, yeah, people are gonna the people. You know, it's one thing to want 250,000 people that can have the patience and pride, of the process and remain still. Stillness is the key. Execute. Stay away from the noise. But on the other side of that, man, that is absolute evisceration of 401ks. Like we're already in motion on that. And Powell said he'll monitor it. I mean, it's wow. I mean, these are the components that get you there. I mean, Apple, by the way, is 14% of the NASDAQ still. So, and we haven't even gone through that. Anyway, this is
look. Like, I mean, I think we're at that part of the cycle, right, where everything goes down. Where you see the true demand destruction, right? It's quad 4. Like I said on the model for Google, I can get earnings down 15 to 20% easy. And I think that might even be conservative. I can get earnings down 30% in the first half of next year based on where I think, just based off of low single digit, mid single digit revenue declines, on an aggregate basis, which given the tough comp dynamics and given where the ad market's currently trending is not crazy at all.
Well, when you say easy, that's amazing. Like some, people on the call have heard this because when I do, one or two in particular major long only firms, always somebody comes at me with, Keith, it's different. The stability of the earnings, these things are fortresses. They won't have cyclicality. They always
so
talk about it that way.
It is so much worse. This is the worst. It is over. Like it is over. This is worse. I mean, I've studied those periods. I didn't live those periods. You did, Keith. I listened to you. I listened to Ami and his background and his knowledge that he has to offer. But we're facing, this isn't 2008. Digital adoption is much higher. We've had massive pull forward in demand. And this is not only just a hangover, but it's companies that are fundamentally over-earning. And they've hired up to a point where their margins are just collapsing because demand's resetting back to a level of revenue and the level of growth, which is now negative, that is not, commensurate with preserving those margins. And so really the bull case on these stocks from here, based on, and I agree with it on my conversations, is that they have to lay people off. The bull case on Meta, the bull case on Meta is that they lay off 20% of their workforce. The bull case on Google is that they lay off 20% of their workforce. You're talking tens of thousands of employees. The problem is that if you lay people off, is consumer demand going to get better? The ad market's going to get worse.
Yeah, that's and the wealth effect is far reaching. I mean, the state of California is going to go into a depression on that front. I mean, it's never mind a recession. And then then don't worry though, because the Fed is going to be assessing the cumulative tightening lags associated with that.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.